the Investor channel where we talk personal finance, setting goals, achieving goals, educating ourselves and our children so we can break the cycle of generational poverty. New video today. We're going to talk about dividend growth. But before we get into it, if this is your first time to the channel, welcome. This is what we do. We talk about personal finance. On YouTube, it's MD Investor, and on Instagram, MD Investor 1. So dividend growth, important topic. So the type of investing we do is called DGI, or dividend growth investing. Essentially, self-explanatory. We invest in dividend companies. They tend to grow their dividends over time, and that's kind of how we make our income. The three main ways that you make income when you invest in stocks during doing this strategy, DGI, dividend growth investing strategy. One, over time you invest more and more money, right? Makes sense. So you'll begin a portfolio and maybe you're investing $100 a month, and then gradually you'll begin to pick it up and start investing $200, $300, $500 a month, so on. So you're making money this way because as you're investing more money, you're buying more shares to get more dividends. Makes sense. The other way you make money is by reinvesting your dividends. So instead of taking it out to go on vacation, buy dinner, buy a new phone, buy a new laptop, you're putting the dividend back into the company. It could be into the same company that paid the dividend, or it could be in a different one. But the bottom line is you're buying more shares with the dividend. So it's almost like a snowball effect. The other way that you make money in dividends, by dividend investing, is that the companies and the company that we invest in are usually stable companies that gradually, or consistently, I should say, raise their dividends year over year, right? So you were getting maybe 50 cents a quarter, and then they raised it to 60 cents, and then 70 cents, and then 80 cents, and so on. So those are the typical ways, three main ways in which you make money in dividend growth investing. And the one we're going to talk about today is dividend growth. Here are a list of dividend aristocrats. S&P 500 dividend aristocrats. Dividend aristocrats are basically companies that are part of the S&P 500 that have consistently or consecutively raised their dividends for at least 25 years. So, you go on a Google search and put in dividend aristocrats and you'll find all these things. These companies, they span different sectors, as you can see: industrial, consumer staples, healthcare. A lot of these are companies that are household names, right? We all have heard of 3M. They've been increasing their dividends for 57 years. We've heard of Coca-Cola. They've increased their dividends for 57 years as well. Colgate, Palmolive, Johnson & Johnson. Some of them we haven't heard of, like Dover Corporation. You might not have heard of it. You've heard of Procter & Gamble, right? Makers of Tide detergent. Probably Hormel Foods, you've heard of those. Target, you've heard of those. So these are companies that are stable, consistent, okay? Now, there are other, I guess I would call it, categories of companies that have raised their dividends. And the one I want to mention is dividend challengers. These are companies that have grown their dividends for anywhere between 5 and 9 years. So dividend challengers. An example of a dividend challenger would be Apple. So they've grown their dividends somewhere between 5 and 9 years. Apple and AbbVie pharmaceutical companies, dividend challengers. I'm just mentioning these because you may come across these terms. Dividend contenders. They've increased their dividends for at least 10 years. Okay, so dividend contenders have increased their dividends by, or for at least 10 years. Examples would be Microsoft and Verizon. Dividend champion. they've increased their dividend by at least 25 years, 25 or more consecutive years, they've increased their dividend. Those are the dividend champions. But unlike the dividend aristocrats, they're not necessarily part of the S&P 500. So you can be a dividend champion, meaning you've raised your dividends for at least 25 years, but you may not be part of the S&P 500. So you may be a dividend champion, but not a dividend aristocrat. But if you are a dividend aristocrat, meaning you're part of the S&P 500 and you've increased your dividends for at least 25 years, you are definitely part of the dividend champion, okay? So hopefully that's not confusing. You can be a dividend champion and not be a dividend aristocrat, but if you're a dividend aristocrat, you're definitely also a dividend champion. And then there's something called dividend kings, and they have increased their dividends for at least 50 years. Okay, so Procter and Gamble, Johnson Johnson, these would be dividend kings. Okay, just want to mention that there are plenty of companies out there that are growing their dividend, and this video is about dividend growth. So what's the big deal if the company you're investing in does not grow their dividend? What's the big deal? In one word, inflation. We know inflation is about 3% per year. And with inflation, as we've talked about before, is basically just the buying power of your money being diminished, right? So you bought, so $100 today, you know, it not will not buy $100 worth of product or services next year because inflation erodes that buying power, right? So if you can buy $100 this year, we'll only be able to buy $97 worth of goods and services next year. And then the year after that, it's going to be 3% less. Because we know about that, right? Grandma, granddad told you that back in my day, you know, I'd be able to buy lunch, breakfast, dinner, and pay the rent with $1, right? Exaggerating, but you get the point. So the bottom line is, if it's important, dividend growth is important because if your dividend does not keep up with inflation, your buying power is going to be eroded, right? This is why when we do our research, we look at dividend growth. We look at something called dividend CAGR or CAGR, which is a mnemonic that stands for compound annual growth rate, right? Compound annual growth rate. And the reason why we look at that is because that lets us know how are my dividends growing, because we want to keep up, not just keep up with inflation. Sometimes we want to maybe go above that, okay? And that metric, the compound annual growth rate, it does help us with that, and you're going to see that in a minute. Now there are companies out there that have a low initial or no low current yield, but they will grow the dividends. Okay. Companies like Microsoft, low current yield, maybe about 1%, but it'll grow the dividend very aggressively. Starbucks is another example. Those companies are probably good for people who have a longer time horizon, right? If you know you're not going to retire for another 10, 15, 20 years, and you don't need the money right now, but your dividend is going to be growing, those companies are fine. And then there's companies out there that have a high current yield, like AT&T, but the dividend growth is very small. Those companies would be probably more appropriate for someone who wants to retire in the near term, right? Near future. So they have a high current yield, but the growth is not that much. Okay. And you may have a company that are in the middle. So their current yield may be somewhere in the medium range, you know, maybe 3%, and the growth is something medium. And you may have a mixture in your portfolio, as I do. Okay. The way I like to think about the dividend growth rate is essentially the company is giving you a raise. That's essentially what it is. And if you compare a raise from your regular job to a dividend raise, you'll see there's a couple of differences, right? So when you get a raise from your job, you know, you may get something like, you know, maybe 3%, maybe 2 or 3%. And as we said, if inflation is 3% and you're getting a raise of 3%, you're essentially just keeping up with inflation. You're not really getting ahead. As compared to a dividend increase from some of these companies where you may get a dividend growth of 6%, 7%, double digits 10%, sometimes higher 15, 20%. So you see the difference, right? Not only would you be keeping up with inflation, you'll be going way ahead. That's how you grow wealth. To get a raise from your job, a lot of times you may have to ask, right? You may have to justify why are we going to pay you a raise. It may be that you know, you may have to say, you're taking on more responsibility, you're managing more people, whatever it is, but you have to kind of justify it, right? And you kind of have to ask at times, right? As opposed to a dividend raise where you don't need to ask. The company, as long as the board of directors agree, just give it to you, right? With a raise from your job, it may come with more responsibility, as I alluded to earlier, right? You may have to come in earlier, you may have to work on the weekends, you may have to stay late, whatever it is, but it may come at a price. You may have to do more work, right? As opposed to dividend increase from your company, which is just passively, right? You don't have to do anything to get it, right? So, like we said, we mentioned there are three different ways in which you can make money, increase money on the dividend or DGI investing is increasing your the money that you're putting into your investments. And number two, reinvesting the dividends. And number three, the companies raise their dividends um, year over year. Let's take a look at a couple of examples and then you kind of see what I'm talking about. So let's look at a company like AT&T. Take a symbol T, AT&T, trading at about $30.81. It pays 52 cents per quarter. The current yield is 7%. Now you know why people love AT&T. But look at the 5-year growth rate, 2%, which is less than the inflation rate. So your dividends would not be keeping up with inflation. But the good thing is that your current yield is good. Now let's look at companies that have a lower current yield. Let's look at Starbucks. Ticker symbol SBUX, trading about $101. The current Starbucks currently pays the dividend 45 cents, pays it quarterly. The current yield is about 1.8%, so under 2%. So nothing to write home about. But look at the 5-year growth rate of Starbucks dividend, 22%, and it's been growing a dividend for 10 years. Okay. Let's look at the dividend growth of Starbucks. So the 1-year growth rate for Starbucks about 12.75%. The 3-year growth rate, CAGR, the CAGR, compound annual growth rate over the last 3 years for Starbucks has been 20.5%. That's tremendous growth. Over the last 5 years, 22%. That's tremendous growth, okay? That's tremendous growth of their dividends. And the rule of 72 says you take 72 divided by the rate of return. So over the last 5 years, you say probably in about maybe every 3 to 4 years, the dividend is probably doubling. So let's look at Starbucks. Right now they're paying about 45 cents. Go back to 2015. They were paying 20 cents, right? Part of 2015, they're paying 20 cents or so. They're paying 16 cents also. And 5 years later, 45 cents. See that? That's more than double. That's what you can get when you are have a high dividend growth rate. Let's look at another one. You can look at let's look at Home Depot. Home Depot, ticker symbol HD, traded about $261. Let's look at the dividends. Home Depot pays $1.50, pays it quarterly. Current yield about 2.28%. 5-year growth rate is about 23.68%. And they've been growing their dividends about 11 years. Okay. Dividend growth for Home Depot over the last year, about 10%. Last 3 years, 25%. Last 5 years, 23%. Last 10 years, 19.71%. Again, tremendous growth. Okay, look at this. That's what you want to see. Up, gradually, up and to the right. That's what they're doing. Let's look at the dividend history. Home Depot currently is paying about $1.50. Let's go back 5 years. 2015, they were paying about 59 cents. 59 cents. And 5 years later, they are more than double. Okay, so 59 cents, 2015. Then the next year, 69 cents, 89 cents, $1.03, $1.36. So from 2015, 59 cents to 5 years later, $1.50, more than double. That's what happened with a high growth rate. Okay. Now let's look at our dividend calculator. And then we should be all done. Okay, so this is again, you've seen this calculator before, a different calculator, you've seen it before on the channel. Investment type, you can hit either, you can do it for individual stock or you can do it for portfolio. Let's do it for portfolio. Taxable account, distribution frequency, we're going to get our dividend quarterly. DRIP, which stands for dividend reinvestment plan. We're going to reinvest the dividends. We'll start with $1,000 and then we'll put about $100 per month. So annual contribution would be $1,200, $100 per month. Tax rate about 15%. Annual dividend yield of the whole portfolio, we'll put 5%. So you're gonna have some high yielders at 7%, some at 1 or 2%, but the aggregate is gonna be about 5%. And we expect year over year to increase our dividend by about 7%. I think that's pretty conservative. That can be done because we've seen companies that are growing it even more aggressively. An expected annual return of the stock or the portfolio to be about 3%. And let's look at 40-year investment horizon. Let me calculate dividends. So as you look here, I remember the analogy they use for the magic penny. You know, you take a penny and you double it every day for 30 days, and you end up with like, $5 or $10 million, I think. Most of the growth happened in the last 5 days of that month. And this is kind of what you see here. It's pretty gradual, low, low, low for most of the time. And then toward the end, it's what they call that hockey stick appearance. That's where, and then toward the end is where it pops up. So you got to be consistent, invest your money regular, and then you're going to see the growth, in time to come, you're going to see the growth. And that's why they said it's a marathon, not a sprint. We've seen this table before. So we put our $1,000 in, and we're getting 5% yield, and it's going to be our annual dividend. We are contributing $1,200 every year, or $100 a month. Year one, we get $50.95. And as you see, as we go through the progression, the growth is very small for the first decade. After the first decade, you're only making $1,700 in dividends annually, right? So making about $150 maybe a month. So nothing to write home about. From the year 11 to year 20, we go from 2,000 to 18,000. So there's a faster growth, right? So it took us a decade to get to about 1,700 in dividend. And the second decade, we went from 2,000 to 18,000. So we see progression. But it's going to go even faster. From year 21 to year 30, we went from 23,000 all the way up to 412,000. What happened there? A lot of growth, snowball, dividend growth, compounding. That's what's happening here. Okay? That's how you take something that's appears very trivial, very small, $1,000 initial deposit and $100 a month. And with the magic of compounding and dividend growth, after 30 years, $412,000 per year in dividends. Now, let's remember that little graph very slow for most of the time, and then toward the end of it, the hockey stick goes up. Just remember the magic penny. Now, year 31 through year 35, we're going from 600,000 to over $3.5 million in dividends annually. And then the last 5 years, you know, the tremendous growth. From year 36 to year 40, you go from $6 million to $65 million in dividends. So I hope this illustrates the power of dividend growth, right? So that's why we do the research and look and see the history, because history is a great predictor of what the future holds, right? If a company has been growing their dividends for 25 years, or like a dividend aristocrat, or 50 years like a dividend king, and they've been through market upturns, market downturns, recession, global pandemic, and they're able to grow their dividends, yeah, the company's still growing their dividends. AbbVie increased their dividends. Johnson & Johnson, the great company, they increased the dividends during a global pandemic. So that's why we do our research, look at the compound annual growth rate. So it gives us confidence that they're growing their dividends aggressively, and we're going to benefit from it year over year if we stay in for the long haul. So just remember, guys, I think stay motivated. I know we're going through a tough time now, but stay motivated, stay invested, and continue to command your money to grow. And I will see you on the next one.